Tom, it's great to have you back. What's the difference between what you see happening in Europe and in the U.S.?
Well, first, thanks for having me. And I think what's different is a sense of urgency to actually start, getting capital deployed to go do this. And what's ahead of us this coming week, I think it'll be a major movement for the CHIPS bill.
What do you make of these rumblings that some others in the chip industry who don't actually manufacture the chips they design might balk at the terms in the CHIPS Act that benefit manufacturers? What are your feelings about that?
No, I think there's broad support across the industry about getting better balance in semiconductor manufacturing in the U.S. Again, 50% of the demand for the semiconductor industry comes through U.S. headquartered companies, only 12% manufactured, down from 37% just in the 1990s. And so everybody knows we need to get this done. There'll always be a certain amount of noise, making sure that the guardrails put in these bills don't derail things. But I haven't heard of anybody not being supportive of this.
Yeah, Thomas, I'm so stuck on these statistics that the American chip-making capacity has fallen so dramatically from the 1990s. And just looking big picture, obviously there's debate about whether this current plan, this CHIPS Act, is exactly the right thing to solve this problem. Do you think that this is going to be enough to ever get the U.S. back to the same capacity percentage of the total that it was, a couple decades ago?
Well, look, I think first we've lost some time here. It's been 2 years in the making. Now, going forward, we're starting with $52 billion CHIPS bill. That $37 billion of that will be dedicated to manufacturing. And I think when you see the economic activity you create for bringing manufacturing jobs, you'll want to continue to make investments. And if you think of the leverage, $52 billion of economic support from the government will be matched by 3 times that amount, is it 30% or 2 times that amount? So it really is $150 billion that will be looking to be added to create capacity in the U.S.
So, Thomas, but as you look at your joint venture in France, I know Citi is a little concerned that it will be a drag on margins. How do you respond to that critique, and what's your outlook on these kinds of joint ventures outside of the U.S. and the potential those offer?
No, I'd say just the opposite. We would never do any deal that's not accretive to our business. And the fact that we're partnering with ST is because going greenfield, going to a new facility, creates a lot of capital intensity and higher cost. And being able to leverage the economies of scale at an existing facility with ST Micro and running our unique recipes and process on tools that we will own and operate in that fab, we'll be able to leverage the economies of scale and be perfectly fine to have the kind of cost that we need to produce our products and have the differentiation to create those products.
Hey, Thomas, it's not the same business exactly, but last week's announcement that Panasonic's going to build this battery facility in Kansas had a lot of people wondering whether or not the political invitation in the United States for production and capital now has a tailwind where you've got global giants starting to think seriously about expanding here. Do you think that's true?
I think part of this is more about, we spent the better part of 2 decades swinging the pendulum to full globalization. And now you're seeing the pendulum come back a little bit. It'll always overshoot from the ideal point. It'll probably go a little bit too far to regionalization. I think that's what you're seeing. I think you're seeing that too much of supply chain security, sovereign security, economic security depends on having manufacturing and technology, predominantly semiconductors, but battery technology for the electrification of cars. I think what you're really seeing is getting some of that localization that we've lost over the last 2 decades back into the country.